Big day today. Obviously, we're getting that Fed decision. How do you see today shaping up? What's your word of the day?
Yeah, today is, we've been waiting this day for almost 2 years since the Fed started its campaign to drive down inflation. This is the first time we're seeing since then that we can have that mission accomplished sign possibly and get that elusive soft landing. So what that means is, listen, the Fed has two mandates. First is to keep inflation low, right? And then the second is to keep unemployment rates low. They're accomplishing both those things, and the market somehow is at all-time highs. And so that, in my definition, is a soft landing. So they have accomplished what many have thought was something impossible. Something's only happened twice in the last 70 years, and so that's what they've been able to do. So you look at the numbers. The Fed's looking at this. They're looking at that they drove down 7% of the unemployment rate in the last 2 years. 7% of inflation is down from where it was when they started, and then inflation
Mark,
is at 30-year lows.
You're keeping us in suspense. What's the word of the day? You didn't tell us yet.
Well, stagflation, like stagnant, you do not want to have it. It means that your pricings aren't going anywhere, either up or down, and that is something that's a killer to any kind of the economy and the markets. You don't want it. So stagflation is the word of the day.
All right, so it sounds like you're kind of concerned about something that Jeff Gundlach's also concerned about. He was speaking to our Scott Wapner yesterday. I want to play the soundbite for you, and I want to see if you agree or disagree with Jeff Gundlach's take.
I think we have a serious chance of a deflationary situation that's occurring. The way when I look at the price of oil, the price of commodities broadly, and layoffs that are coming, which may lead to zero wage growth. So I think the Fed is well behind the curve and should get their act together.
All right, it sounds like you guys are concerned about some similar topics right there. Do you agree or disagree with him? He also went on to say that the Fed needs to cut by 50 basis points.
Yeah, I'm not seeing that 50 basis points is needed based on the data. I do see that there will be potential layoffs, but we haven't seen them to any mass degree yet. And I do think if I'm a Fed board member, I want to have some tools in my toolbox that if things, if SA hits the fan, I want to have some tools to be able to defend it. If I go 50 basis points now and I do another 25 basis points in a month or two, what can I do if we start hitting a recession? The Fed doesn't have many tools, and lowering the interest rate is one of them. I would be more measured if I was on the Fed. So that's what I'd say. But I do agree with Gundlach that this is something that we need to be focused on, and I think the Fed is.
All right, so we're all expecting to cut 25, 50 basis points. We don't know quite yet. Do you believe that all the gains for the cyclical sectors are already priced in if we only get the 25 basis point cut, or do you think that they actually move higher even if we only get that quarter point cut?
If I'm a CEO of a company, I'm just ecstatic that rates are going lower because it makes it cheaper to borrow capital. And so that's what matters to me, whether it's 50 or 25 basis points. If I'm the CEO, completely irrelevant. I'm just happy right now that I'm able to tell my employees and my treasurer, my CFO, that we can borrow at cheaper levels. Let's go ahead and expand our business, and let's go ahead and do those things that we wanted to do 2 years ago, but we didn't know where the Fed was direction.
That's the CEO take, Mark. But what about the market take? I mean, I'm looking at your picks right now. You have two picks for us. One's materials, a cyclical sector that you see moving higher. The other one's gold, which most people think is kind of defensive. So it feels like you're giving us some mixed messages on where you're seeing opportunities in the market.
Yeah, listen, we were at all-time highs. You just said that right before I got on, right? And so you, as an investor, you've got to be keenly aware of that fact. And so while we're going through this scenario where we're trying to land the plane softly, you've got to be defensive because you don't know if that's going to happen. We could crash into the damn tarmac. So what do you do as an investor? You got to have gold. You've got to have materials. You got to have industrials, because no matter what, with AI being a major factor, industrials and materials will do well. That makes the data storage centers. That's going to create the opportunity to take AI to the next level, which is why the market's where we are right now. And gold is at all-time highs. Global demand for gold couldn't be higher. And it's a safe haven in case we're all wrong about the soft landing. So that's why I like Mark, those two sectors.
We're almost out of time. We got to go. But you've named two cyclicals already: industrials and also materials. Do you feel the same way about financials? Do they also benefit from this quarter point cut, and they don't necessarily need the 50 basis point cut? Very quickly, yes or no?
Yes. Yes, I like financials because good luck finding a bigger bank to do any of the business that we're doing on Wall Street every single day.